Hello and welcome to the third instalment of our Investment Insight series, Magellan Minutes. We aim to bring our investors relevant, timely and thought-provoking investment insights, all in around 10 minutes. We've been very happy to receive the positive feedback since we launched the series about a year ago. A lot has happened since we caught up in December, with the vaccine rollout globally and also the effects of the stimulus packages washing through the markets. From ESG to infrastructure, luxury to financials, we discuss the issues and the developments in the stocks and the sectors in our global portfolios. My name is Jennifer Herbert, Key Account Manager at Magellan, and today I'll be speaking with Magellan's Portfolio Manager on the MFG Core ESG Fund, Elisa Di Marco. We'll be speaking about Magellan's integrated ESG risk process and how we value active ESG engagement with companies. Thanks for joining us, Elisa.
Thanks, Jen.
Why does Magellan view ESG investing more important than ever?
So, Jen, ESG has always been important to Magellan. You could actually say that it's part of our DNA. Since the beginning, we have had ESG incorporated into our investment process. So our ESG philosophy has been evolving over time, but our ESG philosophy in itself hasn't changed. So what is our ESG philosophy, you might say? So we take a risk-based approach when we're looking at ESG risk assessment at Magellan. So we're looking for material risks that could impact the company or the industry. So our analysts ask themselves the question, for each of the E, S and G risks, what is material and could that impact valuations? Now, we view that this methodology is really kind of looking at the forest through the trees. We're not getting caught up in the minutiae or all the different ESG risks and controversies that we're often confronted with as an investment analyst. We're looking at what is truly important. We are identifying key risks and we view that key risks can impact returns. We don't view that ESG risks are any different to looking at a macroeconomic risk or a geopolitical risk, for example. All risks can impact returns. Now, I quite like using examples to go through how any risk can impact returns. So if you don't mind indulging me briefly, I will just briefly mention Starbucks. So we view that climate change is a key ESG thematic across portfolio companies at Magellan. Now, specifically for Starbucks, they are at risk from the long-term physical impacts from climate change. So, for example, what we're looking at here is what happens to the coffee bean crops as temperatures rise or as weather patterns become more erratic. Coffee beans are critical to Starbucks, as you can imagine. If you're walking into the store and they run out of coffee, that's not really going to be serving the purpose for their customers. Now, management are acutely aware of this key long-term risk and they're investing for the future. They have got agronomy farms located around the world where they're investing at trying to identify new techniques to farming so that coffee beans can withstand changes to weather patterns. So we view this as a key risk for Starbucks and that it would impact returns in the future if this risk if they haven't begun to manage it right now. So kind of just going back to a bit of the question that I haven't really touched on, which is, do we view ESG more important than it has been historically? So I suppose the short answer is yes. We view that investors and financial markets are increasingly viewing ESG risks as financial risks and that they would impact returns. So that's why at Magellan, we will continue to look at ESG risks as part of our overall business risk framework.
Elisa, you gave us a little teaser about how Magellan thinks about ESG. Could you talk a little bit more to the approach?
Yeah, absolutely. So our approach, it's always linking back to our ESG philosophy, where we're identifying what really matters to each company. They're the key material ESG risks and how it would impact valuation. So in doing that, we have 3 steps. We have ESG exclusions, we have our ESG risk assessment process and scoring, and then the engagement and proxy voting. So whilst they're 3 individual steps, they are all interplay into how we're focused on the investment side and the portfolio construction side. So we're excluding industries that we view have higher or elevated risks that we don't want our strategies to be exposed to. So tobacco is a really good example of that. We exclude tobacco from all of our strategies because there are elevated health risks, regulatory risks, and supply chain risks. We view that they're so high that we don't want to be exposed to them in any of our investments. So with respect to the ESG risk assessment and scoring, we have over 30 E, S and G categories where we're identifying what is material and then how the management team is actually taking into consideration those key risks. We then use those key risks to help guide our engagement strategy with individual companies. The key focus of when we're doing our engagement and our scoring is keeping in mind what's most important to investors at Magellan. So that is risk identification to protect returns for the longer term.
Specifically mentioned Magellan's methodology. How should investors consider Magellan's approach versus other approaches to ESG assessment?
Look, it's a very fair question and something that we get quite often when we're talking to clients because ESG means different things to investors and to individual funds. So we often view that ESG is a bit of an umbrella term, and as a result, there can be a bit of confusion as to really what each fund and each firm is considering with respect to ESG. So it's not like when we're looking at traditional investment attributes where you decide if you would like dividend yield or growth or defensive. It doesn't quite fit into such clear boxes yet. And that's really because the industry and the assessment of ESG risks continues to evolve. And what's just suppose one example of that is like when you think about governments, they are still changing how they're viewing ESG risks. And you've recently seen in the Biden administration in his first 100 days, he committed to climate change being a key agenda item for the administration. And as a result, companies have actively started to address the risks that come from climate change. So it's a real positive change that we've seen, but the industry itself is still in flux. And I suppose just kind of circling back there and how we then think about the industry as a whole, we view that investors just need to consider, well, what is it about ESG that is important to them? And then you can look at what's key and important in each of the products. Now, at Magellan, we are true to label. We're looking at risks and opportunities with respect to ESG. We have active engagement, and it's integrated within our research process.
You touched on the engagement piece with companies. Can you give us some examples of that?
Absolutely. My favourite thing to talk about, Jen. So last year, for example, we had over 700 engagements with our companies within our investment universe. Now, when we're talking to companies, we're talking typically about either kind of fact-finding, which is just better understanding the ESG risks, or we're having conversations to better understand how companies are managing those particular risks. So if we've got time, I might just quickly touch on an example of each of those. So the first one on fact-finding. Earlier this year, we spoke to Estee Lauder, who's one of the largest global beauty companies. So when we were speaking to them, there were lots of interesting topics, but we viewed that responsible sourcing was a key risk for them. So they have over 4,000 individual ingredients that go into their products. And it's really important that they have a sustainable supply chain. So to Estee Lauder, when they're thinking about responsible sourcing, they're looking at how ingredients are going to be sustainable into the future and how responsible the supply chain is. And they're doing several things to manage those risks. They're using blockchain technology to improve transparency. They're engaging with industry to help with the audit process, which overall helps the quality of the supply chain for global beauty improve. And then they're also identifying key ingredients that are at risk to Estee Lauder and investing specifically in those. So then the other element was discussing with companies engagement based on how they're managing risks. And this was a real kind of key one for us as a firm at Magellan through the pandemic COVID year. So we spoke to executive management at restaurant companies and at utilities about how they were exercising their social license. So maybe just the example of the restaurant companies, they have large workforces, which we encouraged the restaurant companies to continue to keep their large workforce and to offer flexibility given there was illness and then there was changes in family circumstances. As a long-term investor, we view that it's really important to protect the brand and the culture of each of the companies that we're investing in. And that was a real key critical engagement for us at Magellan.
Elisa, thank you for your insights today.
Thanks, Jen. It was great to be here.
And thank you for watching. If you have any questions, please don't hesitate to reach out to the Magellan distribution team, and please feel free to share this update with clients and colleagues as you see fit. Thank you.